All right, future CPAs, what's up? On your road to the LCPA, there are some topics you just have to nail down. And today, we're tackling one of the big ones, PAS 8. So let's get right into it. So picture this. You're in charge of your company's financials. Its whole story, right? But then, something changes. You get new info, or maybe you figure out a much better way to do things. So what's the play? Do you go back and edit the past chapters of your financial story? Or do you just start writing the next chapter differently? That's the huge question. And thankfully, PAS 8 is here to give us the answer. And trust me, this isn't just theory. In the real world of accounting, change is pretty much the only constant. Businesses don't stand still, right? New information pops up all the time, we find better methods, and financial reports, well, they have to evolve right along with the business. Okay, so to stop this from turning into, the Wild West where everyone just does their own thing, we need rules. And here in the Philippines, our official rulebook is Philippine Accounting Standard 8, or just PAS 8. This is what keeps everything consistent and clear, so when you're reading financial statements, you're not totally lost. Now, before you even think about making a journal entry, you have to stop and ask the single most important question. Are we dealing with a change in accounting policy or a change in accounting estimate? Seriously, get this wrong and everything else you do will be wrong too. This is the critical first step. So, what exactly is a policy? Well, the textbook definition is all about principles, bases, rules, all that formal stuff. But here's the study hack you need to remember. Think of it as your company's accounting DNA. It's the fundamental code that decides how you operate financially. A perfect example? Your choice of inventory method, like FIFO or weighted average. It's part of who you are, financially speaking. On the other hand, a change in an estimate is totally different. You're not changing your DNA, you're just getting smarter. You're refining your predictions about the future because you have new, better information. Let's say you originally estimated a machine's useful life was 10 years, but now after a few years of using it, you realize, hey, this thing is probably only going to last 8. See? You didn't make a mistake before, you're just making a better, more informed judgment now. All right, so you've figured it out. It's a change in policy. What do? We get in our accounting time machine. I'm serious, we have to go back in time. The reason is all about comparability. If you change the rules halfway through, how can anyone compare this year's results to last year's? They can't. It's apples and oranges. So we go back and apply the new rule to the past. And this whole process is called retrospective application. So, how do you actually use this time machine? It's a 3-step process, super important to remember. Step 1, you go back. You apply the new policy to all the past periods you're presenting, as if you'd been doing it that way from the start. Step 2, you restate. You actually have to recalculate the profits for those prior years. And step 3, and this is the big one, you adjust. You take the total effect of all those past changes and make one big adjustment directly to the opening balance of retained earnings. Okay, theory is great, but let's see this in action with a mini case study. This is going to feel just like a problem from your review materials. So Cotabito Co. decides to switch its inventory method from weighted average to FIFO in 2023. First question you ask yourself, policy or estimate? Easy. Changing your inventory method is a classic textbook change in accounting policy. So remember step 2 of our time machine process? Restate. We have to go back to 2021 and 2022 and fix the numbers. As you can see on the table, if they had used FIFO all along, their 2021 net income would have been 40,000 pesos higher, and for 2022, it would have been 50,000 pesos higher. We are literally going back and rewriting history to make sure the story is consistent. Okay, so what's the grand total effect? We had a 40,000 increase in 2021 and a 50,000 increase in 2022. You add those together and you get 110,000 pesos. That is the number. That's the cumulative adjustment that we need to hit the opening balance of retained earnings with in 2023. We make that one entry, and boom, the past is corrected.
All right, let's park the time machine. What happens if our big change was actually a change in an estimate? Well, for this, we don't look to the past. We grab our crystal ball and look to the future. We're not changing history. We're just changing our forecast. And that's called prospective application.
So what kind of things are we talking about here? Well, some super common crystal ball situations are things like changing the useful life of an asset, or realizing you probably won't collect as much of your receivables as you thought, or even updating your best guess on future warranty claims. See the pattern? They're all about making better judgments about the future. And you know what the best part is? The rule is so simple. The standard basically says you just recognize the change prospectively. What does that mean? It means you deal with it this year and in the future. That's it. No going back, no restating prior years, and absolutely no touching the opening balance of retained earnings. The past is the past. We just move on from here. Okay, so we have our two methods, the time machine for policies and the crystal ball for estimates. Let's put them head to head, a little face-off, to make sure these differences are locked in your brain. Screenshot this, write it down. This is a key slide for your review. Let's run through it. First up, application. Policy change, that's our time machine, so it's retrospective. We go back. Estimate change, that's the crystal ball. It's prospective. We only look forward. Next, timing. A policy change affects the past, the present, and the future. An estimate change only affects the present and the future. And finally, the big one, impact on retained earnings. For a policy change, you must adjust the opening balance. For an estimate change, you don't touch it. Simple as that.
Okay, we've gone through a ton of info, so let's boil it all down to the absolute essentials. This is your official LCPA cheat sheet for PAS 8. These are the brain hacks that are going to make this stuff stick. Ready? Let's do a rapid-fire review. You hear policy change, you think time machine. That means you go back, you restate history, and you adjust opening retained earnings. You hear estimate change, you think crystal ball. That means you look forward, and you only affect the current and future profit or loss. The whole game is governed by one rulebook, IS 8. What's the most classic policy change? Switching inventory methods. Classic estimate change? Adjusting an asset's useful life. Get that down, and you are golden. And that's really it. At the end of the day, PAS 8 is all about one thing, knowing when you need to be an accountant historian with a time machine and when you need to be an accountant fortune teller with a crystal ball. So, now that you know the difference between rewriting history and forecasting the future, we want to know what's the next PFRS or PAS that just messes with your head. Let us know. Thanks for hanging out with us.